personal finance. 7 tips to become financially independent. Have you ever felt like what you make is never enough? Living from paycheck to paycheck, hand to mouth month after month. In this video, we're going to share with you how to break free from this financial status to becoming financially independent. You shall learn how to manage your money as well as learn how to start saving and investing. You can only achieve this by practicing personal finance principles. Personal finance is about meeting personal financial goals, whether it's having enough for short-term financial needs, planning for retirement, or saving for your child's college education. It all depends on your income, expenses, living requirements, and individual goals and desires, and coming up with a plan to fulfill those needs within your financial constraints. To make the most of your income and savings, it's important to become financially literate, so you can distinguish between good and bad advice and make smart decisions. Here are 7 personal finance strategies that you need to pay close attention to. If you want to have a better financial future, take note of what we're going to share with you. The sooner you start financial planning, the better, but it's never too late to create financial goals to give yourself and your family financial security and freedom. Here are the best practices and tips for personal finance. 1. Create a budget. This is something probably that you have heard before. But let us highlight something here. For starters, a budget is essential to living within your means and saving enough to meet your long-term goals. There is a 50, 30, 20 budgeting method that offers a great framework. It's broken down like this. Take 50% of your take-home pay or net income and put this towards living essentials such as rent, utilities, groceries, and transport. The next 30% is allocated to lifestyle expenses, such as dining out and shopping for clothes. Lastly but not least, 20% goes towards the future, paying down debt and saving both for retirement and for emergencies. It's never been easier to manage money, thanks to a growing number of personal budgeting apps for smartphones that put day-to-day finances in the palm of your hand. Examples of personal budgeting apps you can use on your smartphone are Unab, aka You Need a Budget. This app helps you track and adjust your spending so that you are in control of every dollar you spend. Meanwhile, the other app, Mint, streamlines cash flow, budgets, credit cards, bills, and investment tracking, all from one place. It automatically updates and categorizes your financial data as info comes in, so you always know where you stand financially. The app will even dish out custom tips and advice. As a family or individual, you need to start budgeting if you have not done so. This will not only help you control your expenses, but will also help you save for rainy days. 2. Create an emergency fund. In simple terms, an emergency fund, which also is known as a contingency fund, is a personal budget set aside as a financial safety net for future mishaps or unexpected expenses. You need to set aside an emergency fund to ensure money is set aside for unexpected expenses such as medical bills, a big car repair, rent if you get laid off, and more. The emergency fund should be between 3 and 6 months' worth of living expenses is the ideal safety net. Financial experts generally recommend putting away 20% of each paycheck every month. Once you've filled up your rainy day fund, don't stop. Continue funneling the monthly 20% toward other financial goals such as a retirement fund. 3. Limit debt. This is a very important point. Limiting debt sounds simple enough. To keep debt from getting out of hand, don't spend more than you earn. Of course, most people do have to borrow from time to time, and sometimes going into debt can be advantageous, if it leads to acquiring an asset that you wouldn't have if you didn't have money. Taking out a mortgage to buy a house is one good example. But leasing can sometimes be more economical than buying outright, whether you're renting a property, leasing a car, or even getting a subscription to computer software. 4. Use credit cards wisely. Credit cards can be major debt traps. But it's unrealistic not to own any in the contemporary world, and they have applications other than as a tool to buy things. Not only are they crucial to establishing your credit rating, but they're also a great way to track spending, which can be a big budgeting aid. Credit just needs to be managed correctly, which means the balance should ideally be paid off every month, or at least be kept at a credit utilization rate minimum. Given the extraordinary rewards incentives on offer these days, it makes sense to charge as many purchases as possible. Still, avoid maxing out credit cards at all costs, and always pay bills on time. One of the fastest ways to ruin your credit score is to constantly pay bills late, or even worse, miss payments. Using a debit card is another way to ensure you will not be paying for accumulated small purchases over an extended period, with interest. 5. Monitor your credit score. Credit cards are the main vehicle through which your credit score is built and maintained, so watching credit spending goes hand in hand with monitoring your credit score. If you ever want to obtain a lease, mortgage, or any other type of financing, you'll need a solid credit history behind you. Factors that determine your score include how long you've had credit, your payment history, and your debt-to-credit ratio. Credit scores are calculated between 300 and 850. Here's one rough way to look at it. 720 is a good credit. 650 is the average credit. 600 or less is poor credit. So be keen on what level of credit score you're at, and if it's lacking, look for ways to improve it. 6. Pay off student loans. There are myriad loan repayment plans and payment reduction strategies available to graduates. If you're stuck with a high interest rate, paying off the principal fast can make sense. On the other hand, minimizing repayments can free up income to invest elsewhere or put into retirement savings while you're young. 7. Plan and save for retirement. Retirement may seem like a lifetime away, but it arrives much sooner than you'd expect. Experts suggest that most people will need about 80% of their current salary in retirement. The younger you start, the more you benefit from what advisors like to call the magic of compounding interest. That is how small amounts grow over time. Setting aside money now for your retirement not only allows it to grow over the long term, but it can also reduce your current income taxes if funds are placed in a tax-advantaged plan like an individual retirement account. Investing is only one part of planning for retirement. Other strategies include waiting as long as possible before opting to receive Social Security benefits and converting a term life insurance policy to a permanent life. If you learned anything from this video, please like and share it with your friends. It takes a lot of research and hard work to create these videos. Please support this channel by subscribing. Help us reach 1,000 subscribers. With that said, have a wonderful and productive day.